Welcome to Celebrity Investing, your go-to source for insights, tips and updates on navigating the exciting landscape of personal and global finance. Please like, share and subscribe for more exclusive content. This is part 1 of understanding option pricing models, Black-Scholes and binomial method. Do stocks and options mystify you? You're not alone. Navigating the complexities of option pricing models like Black-Scholes and the binomial model might seem daunting at first. But these models are crucial tools for both risk management and crafting smart investment strategies. Understanding them isn't just for math wizards. Investors use these models every day to make informed decisions and stay ahead of market trends. This video will unravel the essentials you need to grasp these key pricing models with confidence. Whether you're a seasoned trader or just dipping your toes into the financial waters, knowing how these models work can open doors to more strategic investment choices. Let's make the math work for you. What are option pricing models? In financial markets, understanding option pricing models is essential. Think of them as tools that help investors figure out the right price for options. These models use math to predict how much an option should cost, helping traders make smart decisions. Now, let's explore why these models are vital to the world of finance. The role of options in financial markets. Options are like powerful tools in the toolbox of traders. They give the owner the right, but not the obligation, to buy or sell an asset at a set price before a certain date. This sounds a bit complex, right? Imagine you're shopping and you find a coupon that lets you buy a gadget at today's price, even 6 months from now. That's what an option does for traders. Why are they important? Options are useful for 2 main reasons. Hedging. This is like buying insurance. Traders use options to protect themselves against market ups and downs. If the market goes crazy, an option can minimize losses. Speculation. Some traders are like fortune tellers, hoping to predict market trends. They use options to bet on where they think prices will go, aiming for profits. Options are a key part of investing because they let traders manage risk and chase opportunities that regular buying and selling can't offer. Need for pricing models. Why do we need models to price options? Without them, setting the price of an option would be like throwing darts blindfolded. Pricing models provide a systematic way to find a price that reflects how the market is likely to move. There are a few reasons these models are crucial. Fair pricing. It's important to have a consistent way to determine the value of an option. Models ensure traders pay or receive a fair price. Risk management. By knowing the right price, investors can make better decisions about how much risk they are taking. Market efficiency. A systematic approach helps markets run smoothly. It keeps prices from being too high or too low, which can create chaos. In the end, option pricing models are like the secret sauces that keep the financial markets balanced. They help investors stay on their toes and navigate the ups and downs of the market with confidence. Understanding the Black-Scholes model. The Black-Scholes model is a cornerstone of financial theory, shaping how we think about options pricing. Developed by Fisher Black, Myron Scholes, and Robert Merton in the early 1970s, this model is widely used in the financial industry. Its primary role is to help traders and investors determine the fair price of options, which are contracts giving the holder the right to buy or sell an asset at a predetermined price before the contract expires. Key assumptions of the Black-Scholes model. The Black-Scholes model relies on a few key assumptions that simplify the complex world of finance. These assumptions, while not always true in real markets, help make the model practical. Efficient markets. The model assumes that markets are efficient, meaning that prices reflect all available information. Constant volatility. It assumes the volatility of the underlying asset's returns is constant over the option's life. No dividends. The model originally assumed that the underlying asset does not pay dividends during the option's life. Risk-free interest rate. It assumes a constant risk-free interest rate, usually represented by government bond yields. Log normal distribution. The model assumes that the price of the underlying asset follows a log normal distribution. While these assumptions may not always hold true in real markets, they provide a useful framework for understanding options pricing. The Black-Scholes formula. The heart of the Black-Scholes model is its formula, which uses several variables to calculate the fair price of an option. Understanding this formula can be a bit like unraveling a puzzle, but each piece plays an important role. The formula itself is CES0.nd1 xc.arart.nd2. Here's what those symbols mean. C, price of the call option. An S euro, current price of the underlying asset. EX, strike price of the option. A risk-free interest rate. A T, time to expiration in years. ND1, ND, cumulative standard normal distribution functions. The formula involves calculating two critical components, D1 and D2. D1 econ frac 1 S0 x plus R plus ton sigma 2 shut dot ton sigma shas dot L sesquor TTT. D2 a D1 a sigma mouse C dot squat T. Add sigma, volatility of the underlying asset. The formula is not just a mathematical tool, but a way to understand market behavior. Applications of the Black-Scholes model. The Black-Scholes model is widely used in real-world trading and investment strategies. It provides a vital tool for assessing the fair value of options, ensuring that traders aren't paying too much or selling too low. Risk management. Traders use it to hedge risk, balancing their portfolios by accurately pricing options. Strategic planning. Investors employ the model to devise strategies based on expected price movements. Market analysis. Analysts rely on it to predict changes in market direction, helping them make informed decisions. By transforming abstract theoretical concepts into practical applications, the Black-Scholes model has a big influence on how financial markets operate. Whether you're a trader, an investor, or just someone interested in finance, understanding this model can be an essential part of your toolkit. The binomial model. The binomial model is a popular method for calculating the price of options, especially when markets take on complex behaviors. This model stands out by breaking down the option's life into several time intervals with binary outcomes. This is similar to predicting if a coin will land on heads or tails, but for stock prices. Since its introduction, the binomial model has helped investors get a clear view of possible market moves, making it a key tool in financial circles. How the binomial model works. Let's take a closer look at how the binomial model does its job. It's a process that unfolds in clear, understandable steps. Tree construction. Picture a tree with branches. The model starts by creating a grid of possible stock prices over the life of the option. Each branch represents a possible upward or downward move. Nodes with possible prices. Each point where branches meet is a node, representing a specific time and a potential stock price. Probability calculation. Assign a probability to each price movement, which might be based on historical data or assumptions about market behavior. Option value at expiry. At the end of the tree, determine the option's payoff at each final node. For a call option, if the ending stock price is above the strike price, the option has value. If not, its value is zero. Backtracking. The model works backward, calculating the option price at each node by considering the possible future payoffs. This involves discounting the future payoffs back at each step using a risk-free rate. Final option price. Once you've reached the starting node, you have the current price of the option. This step-by-step breakdown shows why the binomial model is a powerful forecasting tool. It gives a flexible, nuanced view of possible future market prices. Strengths and weaknesses of the binomial model. The binomial model is not just about calculating prices, it's also about understanding its own value and limitations. Let's dig into what makes this model tick and where it might miss the mark. Strengths. Flexibility. Unlike some models, the binomial approach can easily handle American options, which can be exercised any time before expiration. Simple and intuitive. By breaking down the timeline into small steps, it provides a clear view of price evolution, much like stacking building blocks to see the bigger picture. Adaptability can adapt to changes in volatility and interest rates, making it suited for various market conditions. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.